Let me ask you a simple question. When you enter a long trade, a buy, do you know whether the price you are entering at is cheap or expensive relative to the current move? Most traders do not think about this at all. They see a setup, they see a signal, and they enter. But here's the thing. Institutions think about this constantly. In fact, it is one of the primary filters they use to decide whether to participate in a move or sit it out. In ICT, this filter is called premium versus discount. And once you understand it, you will never again buy at the top of a range wondering why price immediately reverses on you, or sell at the bottom of a range wondering why your short gets squeezed. This is the concept that tells you whether price is currently cheap or expensive, and therefore which direction smart money is most likely to push it next. Let's break it down. Welcome back. Episode 4 of the ICT Concepts Master Series. We have covered market structure, BOS, and CHoCH in the last 3 episodes. All of that knowledge feeds directly into today's concept. If you have not watched those yet, I would genuinely recommend starting from episode 1. The link to the full playlist is in the description. Today, premium and discount zones. Let me get on the chart. Every price move, every single swing from a low to a high or a high to a low has a midpoint. ICT calls this the equilibrium, the 50% level, the exact middle of the range. This midpoint is the most important price level in the entire ICT framework for understanding value. Everything above it is considered premium, expensive. Everything below it is considered discount, cheap. Now think about this from a basic economic standpoint. If you want to buy something, you want to buy it cheap. If you want to sell something, you want to sell it at a high price. Smart money operates the exact same way. In a bullish market, where the higher time frame structure tells you smart money is positioned long, institutions are looking to add to their buy positions when price pulls back into a discount. They are not chasing price at the top of a move. They wait for price to come to them. In a bearish market, where the bias is short, institutions are looking to add to their sell positions when price rallies up into premium. Again, they wait. They do not short at the bottom of a range. They wait for price to give them a better price. This is the foundation. Simple, elegant. And most retail traders do the exact opposite. They buy when price is pumping into premium, chasing the move, and they sell when price has already dumped into discount. They are always late. Institutions are always early because they use this filter. Now let me show you exactly how to map these zones on your chart. ICT uses a Fibonacci retracement tool. And before you scroll away because you have seen Fibonacci used in 1,000 ways before, this is different. ICT does not use Fibonacci the way most people do. Here is the exact process. Step 1. Identify a clean swing. A clear swing low followed by a clear swing high in a bullish move, or a clear swing high followed by a clear swing low in a bearish move. Step 2. Apply the Fibonacci retracement tool from the swing low to the swing high. In TradingView, you drag it from the low up to the high. Now the key levels ICT cares about here. The 50% level is your equilibrium, the dividing line between premium and discount. Everything from 0% to 50%, the lower half, is your discount zone. Everything from 50% to 100%, the upper half, is your premium zone. In a bullish move, you are looking for price to pull back into the discount zone, ideally between the 50% and the 79% retracement levels, before you start looking for buy setups. That deeper discount is where smart money gets the best possible price on their long entries. The 61.8% and 79% levels are particularly important within the discount zone. And that deeper concept of entering specifically at those levels is what ICT calls the optimal trade entry, or OTE. We will cover that in its own dedicated episode later in the series. For now, just know that the deeper into discount you can enter, the better your risk to reward becomes. In a bearish move, you flip the logic. Apply the Fibonacci from the swing high down to the swing low. The premium zone is now the upper half, the 50% to 100% retrace area. That is where you want to be selling. Here is the critical thing to understand. Premium and discount are not standalone signals. They are a filter. They tell you whether the current price is a good location to be looking for entries, not whether you should enter. The way this works in practice. First, you establish your bias from the higher time frame structure, bullish or bearish. You already know how to do that from episodes 2 and 3. Then, once you have your bias, you use premium and discount to judge the quality of your entry location. If your bias is bullish and price is sitting in premium at the top of a recent range, that is not a good place to buy. You are buying expensive. Smart money has already pushed price up and is likely looking to offload. You wait for a pullback into discount before you start looking for setups. If your bias is bullish and price has pulled back into discount, into that lower 50% of the recent swing, now you are in the zone where smart money is likely to step in and buy. This is where you start looking for confirmation. An order block, a fair value gap, a liquidity sweep. We will cover all of those in upcoming episodes. But premium and discount tells you where to be looking. Think of it like this. Imagine you want to buy a specific stock. You would not buy it at its 52-week high. You would wait for a pullback and buy it at a discount. ICT applies this same logic to every single price move, on every time frame, across every asset class. And this is why so many ICT traders avoid taking trades mid-range or at obvious highs and lows. They wait, they are patient, they let price come to them in premium or discount, and then they act. If you're serious about trading, you need more than just knowledge. You need the right tools. At the DTCtools.com, we've built 3 professional-grade strategies: CCT, DTC, and DTC Precision Pro, each with its own trading view indicator, MT5 automated bot, and live signals group. Whether you're passing a prop firm challenge, managing a funded account, or trading your own capital, we have a system built specifically for your goal. No guesswork, no emotions, just systematic, rule-based trading, engineered for consistency. Follow us on Telegram, link is in the description, and use code TELEGRAM20 at checkout for 20% off your next order. Visit the DTCtools.com and find the tool that fits your trading journey. There are 2 mistakes I see constantly with this concept, and I want to address them directly. The first mistake is drawing the Fibonacci on the wrong swing. Premium and discount are relative. They only make sense in the context of a specific swing. If you are on the daily chart, you draw your Fibonacci on the most recent significant daily swing. If you are on the 4-hour, you use the most recent 4-hour swing. Mixing up time frames when drawing your ranges will give you meaningless levels. The second mistake is using premium or discount as the only reason to enter a trade. Just because price is in discount does not mean it cannot keep going lower. Discount is a filter, not a guarantee. You still need a confluent reason to enter: a structural level, a reaction zone, a specific pattern. Premium and discount narrows your focus. It does not replace the rest of your analysis. In the next few episodes, we are going to add layers on top of this: liquidity, fair value gaps, order blocks, and you will see how premium and discount becomes a powerful pre-filter that makes every other ICT concept more precise. Let's wrap it up. Every price swing has a midpoint, the 50% equilibrium. Everything below it is discount, where smart money looks to buy in a bullish market. Everything above it is premium, where smart money looks to sell in a bearish market. You use the Fibonacci retracement tool to map these zones. You use your higher time frame bias to decide which zone matters. And you use premium and discount as a filter, not as a standalone entry signal. If your bias is bullish and price is in discount, that is where you pay attention. If your bias is bullish and price is in premium, you wait. That patience alone will save you from a huge number of bad trades. In episode 5, we are going into liquidity, buy side and sell side. This is the concept that explains what smart money is actually hunting when it makes those moves that take out your stop loss right before the market reverses. It is going to make a lot of things click that might not have made sense before. Leave a like if this was useful. And in the comments, tell me, have you ever entered a trade in premium thinking it was going to keep going, only for it to reverse immediately? I guarantee most of you have. Drop it below, subscribe, and I will see you in episode 5.